For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Over the past year, Palantir Technologies has emerged as one of the most talked about stocks on the market. Since the start of 2023, its share price has experienced a jaw-dropping increase of over 2,300%. That equates to a return of more than 20 times the original investment within a span of only 2.5 years. This kind of growth has made a substantial number of investors significantly wealthier. The company, which focuses on artificial intelligence and data-driven software, has carved out a dominant position by working closely with major clients such as the United States Department of Defense. As a result, it has gained attention not only for its explosive stock performance, but also for its expanding presence across both public and private sectors. What is especially noteworthy about Palantir is how it has maintained this upward momentum while operating at a massive scale. Just recently, the company's stock pushed beyond the $150 mark, which in turn pushed its total market valuation to approximately $350 billion. According to this particular author's analysis, one of the most striking developments is how Palantir continues to build momentum even after reaching such a large scale. During its most recent quarterly earnings update, the company reported revenue of $884 million. This marked a year-over-year increase of 39%. The bulk of this growth came from the United States, where Palantir saw revenue growth of 55%. Even more impressive was its performance in the US commercial sector, which includes private companies. In that space, the company experienced a 71% increase in revenue compared to the same quarter last year. Profitability is also improving for Palantir. The company posted an operating margin of 20% in the latest quarter. Over the trailing 12-month period, its operating margin stood at 13%. These figures highlight the company's ability to efficiently manage costs while scaling its operations. Palantir already enjoys strong gross margins, and as its business continues to grow, there appears to be a clear path for even greater profitability. These margins are not just short-term wins, they are signs of a maturing business model with expanding leverage as new customers and contracts are added. When evaluating the company's outlook, the indicators are just as promising. In the first quarter alone, Palantir closed 139 deals valued at over $1 million each. On top of that, 31 of those contracts were worth at least $10 million. These high-value deals reflect the company's growing influence and credibility as the artificial intelligence operating system of choice for large organizations. The company's technology is not just theoretical or experimental. Major players are putting serious money behind it. For example, the United States Department of Defense currently holds contracts with Palantir worth over $1 billion. Given the size and complexity of defense operations, there remains ample room for Palantir's role to expand even further in the coming years. Beyond defense, Palantir is beginning to explore entirely new industries where it can apply its artificial intelligence expertise. One standout example involves a partnership with a company known as the Nuclear Company. This organization is planning to build gigawatt-scale nuclear power plants within the United States to help meet the country's rising electricity demand. Palantir is providing the software that will serve as the operational core for this energy supply chain. The goal is to use advanced artificial intelligence and analytics to reduce delays in the approval process and avoid expensive mistakes in construction and operation. This is not a small-scale experiment. The US government is expected to allocate hundreds of billions of dollars and possibly even trillions toward developing new nuclear energy infrastructure. If Palantir remains at the center of these efforts, the opportunity for expansion could be tremendous. In fact, this push into nuclear energy is just one example of Palantir's broader strategy to enter high-value sectors that are undergoing digital transformation. Its software tools are being recognized for their ability to enhance decision-making, streamline operations, and manage massive volumes of data across industries. Whether in healthcare, manufacturing, supply chains, or national security, Palantir's reach is expanding. At the same time, spending on artificial intelligence and data analytics is expected to rise steadily over the next decade. As these industries evolve, more organizations are likely to turn to Palantir to help manage that transformation. Currently, the company's revenue is tracking at an annualized run rate of $3.5 billion. While that is already impressive, there are projections suggesting that Palantir could eventually generate $10 billion or even $20 billion in annual revenue. If this vision becomes reality, Palantir would become one of the most dominant software companies of the decade. There is clearly a lot to like about the company's underlying business model, its long-term prospects, and its leadership in the artificial intelligence field. However, while the business outlook remains strong, there are serious questions about the stock's current valuation. Palantir's market market capitalization, now sitting above $350 billion, results in a price-to-sales ratio of 122.7. It is critical to emphasize that this is a price-to-sales ratio, not a price-to-earnings ratio. To put this into context, the Standard & Poor's 500 index currently trades at a price-to-sales ratio of about 3.2. Many investors already view the Standard & Poor's 500 as being expensive. That means Palantir's stock is trading at a premium that is almost incomprehensible, especially when compared to broader market benchmarks. The high valuation implies that investors are expecting enormous growth over the next several years. If Palantir does manage to increase its revenue to $20 billion annually within a decade and achieves a profit margin of 30%, that would result in $6 billion in annual earnings. Based on its current valuation, this would still leave the company with a price-to-earnings ratio of nearly 60. It is important to understand what that means. A 10-year forward-looking price-to-earnings ratio of 60 is still more than double the historical average for the Standard & Poor's 500 index. Even with optimistic assumptions, the numbers suggest that the stock is priced for perfection and that any misstep could lead to major downside. According to the author's viewpoint, Palantir's stock performance in the future is unlikely to mirror its dramatic gains of the past few years. The company itself remains solid, innovative, and ambitious. It continues to gain traction in both public and private markets, and its software tools are helping to redefine how organizations approach data and artificial intelligence. However, from a valuation perspective, the stock may already have priced in more success than is realistic to expect. For that reason, the author believes that buying Palantir shares at this level carries a high level of risk. In the end, Palantir Technologies has delivered extraordinary returns since early 2023, gaining over 2,300% in value and recently surpassing $150 per share, which pushed its market cap close to $350 billion. The company is showing strong revenue growth, especially in the United States, where commercial sales rose 71% year over year in the most recent quarter, and it continues expanding its profit margins. With high-value contracts, including over $1 billion from the United States Department of Defense and partnerships like its work with the nuclear company, Palantir is broadening its presence in key industries. Its revenue run rate has reached $3.5 billion annually, and some believe it could grow to $10 billion or even $20 billion in the future. However, despite the solid business performance, the author warns that Palantir stock may be highly overvalued, with a price-to-sales ratio of 122.7 and a projected price-to-earnings ratio near 60, suggesting that investors should be cautious about buying the stock at current levels. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.